A lot of founders believe the answer to every business problem is more revenue, more leads, more salespeople, more marketing, more activity. But what if the problem is not that your company needs more revenue? What if the problem is that the revenue you already have is leaking out of the business before it ever turns into profit, cash flow, or enterprise value? Welcome, or hopefully welcome back to The Reluctant Entrepreneur. Today's guest is Doug C. Brown, founder of CEO Sales Strategies. Doug works with founder-led companies to uncover hidden profit inside the business by identifying revenue and margin leaks that quietly impact cash flow, scalability, and enterprise value. Today, we're going to break this conversation into two segments. In the first segment, we'll get to know Doug's entrepreneurial journey. We'll talk about the highs, the lows, and of course, everything in between. How he got started, what he learned along the way, the mistakes that shaped him, and the lessons that helped him become the advisor and entrepreneur he is today. Then, in the second segment, we'll shift into Doug's specific area of expertise, helping founder-led businesses find the money that's already hiding inside the company. We'll talk about where profit leaks occur, why more revenue does not always mean more value, how to improve EBITDA without simply adding more leads or more headcount, and what investors and buyers actually look for when they're evaluating the financial performance of a business. And it all begins right now. Stick around. Doug C. Brown, welcome to the show. I'm excited to have this conversation today.
Mike, thanks for having me here. I'm so grateful.
Doug, let's go back in the Wayback Machine. Let's go back in our time machine. Before we get into revenue and leaks and hidden profit and all the juicy stuff, tell us about your own entrepreneurial journey. How'd you get here?
Well, it's an old time machine. I can tell you that now.
It's still working.
It's still working. Believe it or not, I started working at the age of 3 for my father's business. And yeah, I actually was 3 years old, and I swept floors for 25 cents a week.
A week?
And a week, yeah. And well, back then I didn't know, 25 cents was a lot of money for a 3-year-old back
what's
then.
What's a 3-year-old going to do? He's not going to get in the car and go to the candy store, right?
No, but he was brought to the candy store.
They
would bring me to the candy store. And back then you could buy a handful of candy for a penny.
Yeah.
So, I could have literally probably put myself into a diabetic coma on 25 cents back then. But my parents wouldn't let me do that, right? I get maybe a fistful of candy, and that would be it. But I think, what my dad was doing back then was starting to show us the discipline of work and how life works as you get older. And about age 5.5, between 5.5 and 6, all my brothers, we went through the same thing. We actually started selling to people who came in. So it was a family-owned business. All the adults were there, and they would teach us how to write orders and how to talk to people and things like that. And that's when I kind of got the little bug for leverage, I think, way back when. Because I remember selling a part. I was maybe 7 or 8 years old. I sold a part for $20. And at that point, I was getting 25 cents a week, not a week, an hour. So I was making $10 a week. And I was like, geez, we paid $10 for this part. I just sold it for 20. Took me like 8 minutes, but I've been working all week long for $10. So 40 hours versus 8 minutes. And I went, there's something here to, leverage, right? I didn't know what to call it back then. So I worked with my dad till I was 19, then went into the military. Always had sideline businesses all the way in between. Had them in the military, came out of the military, had to go to college because that's what you do back then, especially in my family. Two things, military and university. And so did that, was selling music equipment to a lot of the big bands that a lot of us were listening to on the radios at that point. And somewhere along the journey, I figured that sales and building business was much more fun than, at that time I was working in the hospital. I got my degree in nuclear medicine and biology and business. And I never kind of looked back. I took a corporate job selling, tripled my income from the hospital, and then started helping companies do the same. And then along the process and the path of that, from some of the work initially I did with my dad, I started figuring out, hey, we can tweak these margins and create more profit by doing the same activity we're doing today, just slightly different. And that yielded far more money at the end of the day, the week, the month, the year, and so on and so on. And that turned into finding hidden profit and hidden revenue in companies.
And how did CEO sales strategies evolve? What was the genesis of that?
So I had been building sales teams, commission-only sales teams, for different organizations, including my own. And someone said to me, you're tweaking all these things in my company. Why don't you just do it for yourself and go start an advisory or consultancy for the thing? And I said, all right, well, I'll do that part-time. And then before you knew it, I had half dozen clients. And at one point we had 37 clients a month doing, in the business. And it just sort of caught on organically at that point. And then we were like, hey, we've got something here. Why don't we, formalize it? And that's how it all came about. Like many businesses, sometimes they come by, the thing you think you're going to do is not the thing you think you're going to do. We still build teams today, but not as many as helping people with profit they've already earned.
If you want to hear God laugh, tell them your plans, right? That's
yeah.
So you work with founders today, but what were some of the early lessons you had to learn the hard way in your own career?
Oof. How much time do we have for this podcast? Because I have so many.
I know, right? It's going to be a mini series.
Yeah. One of the biggest, I would say, breakthroughs for people, if they really take heed of this, is really two things. Number one, understanding who your ideal right fit buyer is for your offering, the economic right fit buyer. That took us a while to dial in because things were coming organically and they were frankly coming inbound. We didn't pay attention to it as much as I would have earlier on, knowing what I know now. And the second thing is that no matter how good you are or no matter how good things are going, it's always going to take you usually twice as long or sometimes 3 times longer than you figure to actually pull off what you think you're going to pull off. Those two lessons were, hit hard, and we abide by them today.
What was the genesis of what you eventually realized that revenue alone was not the full story? How did that discovery come about?
So I was working with a company. We were interviewing this company, and I talked to them, and they were over $1 billion in revenue. And I asked them, I said, well, what is your EBIT? What is your EBITDA? What is your operating profit? And they answered the question like this, Mike. They said, we are over $1 billion. And I said, yes, I know that. That's your revenue. What's your operating profit? We take the cost of goods out, all these things. What is this?
This minus this is this. Yes.
Yeah. It's math, right?
Yeah.
And they said, well, we're doing over $1 billion. And I said, guys, maybe I'm not saying this correctly. If we take this ratio, revenue, and then subtract cost of goods and do that, what is the EBIT and EBITDA of the business? And they said $1 billion. And I asked them this question: how much money are you losing? And they said, we're losing $72 million a year.
There you go.
And
wow.
That was when it dawned on me that even these huge companies, they don't get it right. And at times, and many smaller companies have the same challenge. And, that's kind of where the mission was born, because I don't want to see people working really, really hard and not having the money they want now and being able to exit on their own terms if they want to exit down the line.
So you've worked with lots of founder-led companies. What
Yeah.
patterns do you see repeatedly in founders who are smart, driven, hardworking, but are still leaving money on the table, like your billion-dollar people? What?
Yeah.
There's got. I'll bet you there's a pattern common to many of them.
Yeah. And quite frankly, most, a lot of founders, CEOs of companies, they're really focused, sales and marketing focused. They were just born that way, grew up in that role. Then there's a percentage of them, which is smaller, much smaller, that are kind of finance driven. And then a much smaller percentage of people who are process driven or being an integrator. The majority of people are looking at their numbers. They're so in the numbers, like they're inside the numbers on a daily basis, that when they read something like a purchase, P&L or something, or they read even a sort of a pipeline report, they're kind of looking at it from like, okay, this makes sense. We've got this like number that's repeating, and they get used to it. Then a guy like me comes in with a fresh set of eyes, pulls all this data, aggregates it, and I come back and I say, you're leaving $3.2 million on the table every single year. And they're saying, yeah, but my CPA isn't seeing the same thing. And I'm like, because you're reading the P&L from a point of view of a CPA. Let's look at what the P&L actually shows for visibility, or the data from your CRM shows for visibility, or all along the customer journey, there's different points we look at, and look at it from a different lens. That's all. Same numbers, just a different lens. And you'll find what I call gap zones throughout a company. So gap zones being these certain places where something is off, but it's looked at as a normal part of business. And so I'll give you an example. So at one time I was the independent president of sales and training for a company that was owned by Tony Robbins and Chet Holmes. And when I first took over, I looked at the numbers like I do in a company today, and I realized that we had a 15% refund rate on the front end of one of our product offers. It wasn't a lot of money. It was $229. But we were driving between 1,000 and 3,000 leads a week. So at 2,000 leads coming through, people coming through, it's 300 refunds basically coming through a week. Again, not a ton of money, but enough money. So I did a little bit of investigating, and I found that our team was actually inviting the refund, and I made some language changes to when we were talking with the clients, and our refund rate within 24 hours dropped from 15% to under 1%.
Just by wordsmithing your offer or your call to action or whatever it was.
Yeah, Mike, because they were inviting the refund. They would say something like, they were in a training, and in the training they were saying, listen, if you don't think we earned our money today, if you don't think we went way above, if you don't think we went 10, 20x above, I want you to drop off this call and call 1-800, get a refund right now. Do it right now, drop off the call right now. And that was the language. And all I did was change that language from that. We would go around the room and have people add up all of the breakthroughs and what it quantified in the terms of dollar value for them. And then we asked people to report it. Said, hey, what did you get today? Oh, I found $2.7 million. Oh, I found $1.8 million. I found $21 million. And then we went around the room, added them all up and said, hey, we found $147,326,000.14 on this call today. And I took this from Tony Robbins. Everybody go, woohoo. And the whole room would go, woohoo. And I say, I guess we earned our fee today. What do you think? And they, yes. And they go, yes. And then we moved on. No one, nice. Barely anyone refund. It refunded out on the process. Now, what I want people to catch is not just that refund rate dropped. The people who pushed through bought at 42.5%. A program between $4,000 and $12,500. So let's just make the numbers easy and say 80 people moved through there weekly, spending on average $6,000.
Wow. Yeah.
11% of them went on to buy something more between $35,000 and $250,000.
Interesting.
So if you add that up week after week after week after week, it is a sizable number at the end of the year.
Yeah. All through a little verbal manipulation. I don't mean
That's
manipulation in a scandalous way. Just careful crafting of the message. That reminds me when I was a kid, 13, 14 years old, all the guys were trying to date all the girls. And there was this one friend of mine, Marty. I don't remember his last name. Doesn't matter. And he would go up to every girl and he would go, quite literally, you wouldn't want to go out with me tomorrow night, would you? It's okay if you say no. And of course, he just had no's all the time. He made it easy. Yeah. He gave them permission. And, the other guys were, that was not the way we did. I don't think we had a 100% track rate. We probably had a 30% track rate, but he had a 0% track rate. And we always talking to him like, dude, you got to change your pickup line. That's a horrible pickup line. Was there one particular mistake that you either made or witnessed early in your career that helped shape how you advise business owners today? And I ask that because I learn way better from failure than I do success. Yeah. I don't know if I do something that's successful, I don't know if I was lucky or if that was skill. I know if I try something and I fail, that's probably not bad luck. It's more than likely me. So did that ever happen to you?
Yeah, I mean, there's a adage, you're either growing or you're learning, or you're on the wrong track and you keep going down that. That's the place we all don't want to go on. But on the positive side, you're always learning or you're always growing. So you win sometimes and you learn sometimes, right? So there's been a lot of times where, I'll tell, like when I first entered into building software, like we have a SaaS company that we're building software. I built the software first versus going to sell it on a prototype. We spent $500,000. When we got it there, people didn't want it. That was a lesson. Yeah. And I don't want to do it again, right? So the thing that got me really started on this, Mike, is it was my dad's business. When I was 12, I went to them and I said, geez, we're looking through, because it was a family business. So I got to look through the numbers and they were explaining to me like how numbers worked and, how you pay your taxes and things like that. And I noticed the line there that basically we were being taxed on all our inventory. And I'm like, why would we be taxed on inventory? Like we paid for it. It's sitting on our shelves. Why? And, and it's like, well, the government wants, so they count this as an asset, blah, blah, blah. And I'm like, that's so stupid. Like, I'm like literally thinking this and saying this. And they're like, well, that's the way it works. I said, well, why are we keeping the inventory on the shelf? We're literally 20 minutes away from the warehouses or Granger. And it was an industrial machinery company that we had, industrial sales and repair company. And I'm like, why don't we just send, Dave to the place once a day to pick up all our parts and then come back and we won't keep the inventory? Or doesn't Granger deliver? That type of thing. And so what ended up happening is we cut the inventory in more than half. Well, that does two things. Number one, you don't pay the tax on it for sure. And number two, it opens up more cash to work with that we could deploy into other things that were now assets, such as marketing, prospecting, those type of things, going to a mixer or an event that we couldn't have gone to because it cost $5,000 or whatever to get into, right? That type of thing. And we go, we didn't have it back then. Well, now we unearth money to be able to go out and have lunches and dinners and, schmooze and do all that stuff. So I think that's, I learned from my failures, but I've also learned from my dad's company's failures and client failures. And, we see a lot of things and then you can stack them up over time and there's a lot of overlap. So you know what not to do then. And that, I believe that's called wisdom at that point, right?
At that point, yeah. You said something earlier that struck me because it reminds me of a saying that I say regularly. You describe sometimes you win and sometimes you learn. And,
Yeah.
I say there are winners and learners, right? We like to say winners and losers, but really there are winners and learners if you
Yeah.
take the loss and apply it. You talk about hidden profit already sitting inside the business. What does
Yeah.
that mean in practical terms?
Well, there's money sitting inside everybody's business that's just lying dormant. And sometimes it's sizable. Like I just talked to a software company, they're doing about $40 million. And on our first call, we identified $5 million just sitting in their business. That's not a bad conversation
Not bad.
for a day, right?
That's not couch
Um,
change.
no, no, no. No, but the reaction's always the same. Like, really? Like, it's there. Yep, it's right here. And so how does this happen? Well, it happens in the sales process for one, right? So there's things like transactional value that is too low. There is pricing that's too low. There is referrals that aren't happening. There are dropped proposals. There are dormant clients. There are places that it drops between, say, sales and operations, where the order gets handed off incorrectly, or the order was written incorrectly, and then operations has got to go back and clean it up, and it takes twice as long or three times as long to install something. Or worse yet, it takes three times longer to install something, and the client says, "No, thank you, I can't wait that long." Because there was a lack of communication about we didn't have certain parts. Customer service, there's leakage all over the place in customer service, where customer service should be a sales process, not just a customer service process. Finance, I just looked at, this was really like, wow. A company that just had a little over $8 million that hasn't been collected in over 90 days. There's all kinds of things that happen in a business through every piece of the customer journey where there are either something that's dropped or something that wasn't installed. One company I looked at, they had 170,000 leads that were never followed up on one time.
Wow. Wow,
Yeah,
that's
it's a lot
staggering. Yeah.
at $13 a lead.
Wow. That's crazy.
Well, and the nutty part is, Mike, is all we did is they were recruiting new salespeople constantly. And I said, take all these dormant leads, give them to the new salespeople and tell them they can't get on the team until they close at least two. And that's what they did. And these dormant leads, people were closing 5, 7, 10 of these leads over time. And clients were literally going, geez, I thought you forgot about me. I hadn't heard from you in a year, And so, there's money. I mean, think about it. The company spent out all that money for leads. That money's just sitting there asking to be mined. And now you go back and mine it. And all of a sudden it's like that money that was now dead and written off the books, because some of these leads were 2 years old, are now being generated in today's new P&L going forward. And so that will increase your margins in a big way. That's profit sitting there at that point.
Yeah, for sure.
And looking at a P&L, like maybe you did a software build out, but they will classify that as an expense, which it should make sense. But next year, it doesn't explain that, it's not in the pipeline, if you will. So once it's in the other things are in the pipeline, that one-time expense doesn't apply anymore. So it's like, it depends on whether you're looking at certain numbers or we're looking at process, but the combination of the two always work out, that there's hidden profit and hidden revenue sitting in businesses, usually between 5 and 20%.
Wow. Wow. And depending on the scale of the business, that could be a lot of dollars. If you're talking about
Yeah.
your $1 billion revenue company, right? That's a huge
Yeah.
number. That's
It's a
crazy.
huge number. And even on companies that are even sub-million, I've looked at some of these. There was a plumbing company that I just looked at I think it was about 7 months ago now. They were $772,000 in revenue. We found $226,000 in EBITDA in that $772,000.
That's a major
And
percentage.
yeah. And they were wondering why they didn't have any money that they could put into their payroll, right? And so the hard, crazy part was even the expenses. We went to an expense reduction process, not to like take things out they needed, but looking at things that they weren't even paying attention to.
Yeah.
And we recovered from their vendors for them $63,000 in 6 weeks,
Wow.
just sitting there.
Waiting to be discovered.
Yes.
When I was reviewing your website, CEO Sales Strategies website, I saw that you mentioned things like pricing that has not been revisited, proposals that go dark, disappeared customers, eroding margins. Which of those trends tend to surprise founders when you point them out? Maybe all of them.
All of the above.
Yeah. Yes.
Not all. I mean, look, most companies know their follow-up is poor, right? That one doesn't usually surprise them. But what they don't realize is you can bump your revenue by 5 to 15% reasonably easy using the right type of follow-up.
Yeah.
So that'll surprise them. But I would say the biggest one is out of all of those is the dormancy of what should have happened that didn't happen that they don't have the visibility to. Because they might be looking at, like, depending on the size company, the CEO probably not looking at the sales statistics. The CEO is looking at the sales revenue that comes in the larger margins, but not drilling down into the numbers, like we do. Like we'll look at things like, okay, how many outreaches did your sales team make and how many connections came from that outreach? Why would we do that? Because when we see that somebody reached out 300 times and they got one appointment, we know there's a messaging issue or something. They're calling upon the wrong client or what it might be, right? Now, the opposite, if they reached out 100 times and they got 100 connections, and then the next ratio would be what are the response rates? If it's 50 good ones and 50 bad ones, they're doing pretty good. If it's 89 bad ones and 11 good ones, okay, well, the next question is how many of those good ones turn into appointments? So we can start micro measuring ratios in these things, and we can then conclude that for every 100 outreaches, we're going to get X amount of appointments. But if we can take that X amount of appointment and then bolster that thing up by 10 or 20%, and it's not hard to get 10% increase, then what that does is it pushes that 10% all the way through the rest of the customer journey. So if our close rate is 1 in 4, let's say, and we push 10% through, we're going to see a 10% bump in overall revenue. Now, what does that do? That also increases the profit, because if we're paying for leads, that 10% of the leads that aren't closing are now closing. So now our cost of acquisition is much more happy, if you will.
Yeah, there's a very positive knock-on effect. That 10%,
Yeah.
like you said, it travels all through the arteries of the company.
Yeah, and if we can take 3 to 5 of those ratios and optimize them and get a 10% lift on each one of them, it's compounding interest.
Why does more revenue not always translate to more value? We all fall into that trap, the seduction of more revenue.
Yeah, revenue is that thing that, revenue is like bragging rights, right?
Yeah.
We're doing, X amount of whatever revenue.
$1 billion a year, like your your previous experience. We do $1 billion. Well, what are you making?
Yeah.
We do $1 billion.
Exactly. But
Stuck on that.
it depends. There is a time for just revenue growth, like depending on what we're going to, if we're just going to try to grab market share and, we want to be attractive on the market share for an investor or something like that, there are times to do that. But most of the times, most people are looking for, I want more money now and I want more money in the future. And I'm building a business that is sustainable. So when you're doing that, we've got to look at both sides of the equation, the money in, the money out. And that's what determines, like if we took a formula like money in plus money out equals, it's either loss, break even, or profit. I mean, that's the only three options. But if you put another equal sign next to whatever that answer is, and then you draw a picture and you write the founder's name on it, that's what their life is going to be like, right? So it directly equates with the quality of life for some human being or human beings within the company and outside the company with their families and friends. It determines, you know, how the quality of their life would be. Many of us, not all of us, but many of us have seen the National Lampoon, Christmas Vacation movie or whatever with Chevy Chase, right? And he was
Sure.
expecting to get a bonus at the end of the year that didn't come through, but he already paid for a swimming pool that he was going to put in to surprise his family. It's that type of thing, because there's always things that come up in life and we don't expect it. But when we can have more money than we have going out, we live a better quality life. And that's just the way it works.
Yeah. Your diagnostic process includes looking at revenue and profit drivers, team interviews, P&L review with contribution margin analysis, and customer journey mapping. It's pretty thorough. Why is it important to look beyond just the financial statements?
Well, the financial statements can tell you a story, but they're not always right.
Mm.
They don't know what's going on in the pipeline. They don't know. See, one of the reasons we do customer and internal employee feedback is because they see things that the numbers don't tell you. Like, if you take somebody who's been at this company for 5 years and they know this is broken, they might have been complaining about this for the past 4.5 years, but nobody's really paying attention. But when they say it's broken and then 6 other people say it's broken and I report the numbers that this is broken and it's costing the company this, then magically it gets repaired. So one of the greatest assets in a company are the people within the company. And when the people are not being heard or been able to voice and it's been taken seriously, that erodes profitability and drops your revenue because people don't go the extra mile. They don't even go the mile. Sometimes they're just skating by.
Yeah.
And I'll see this in sales teams all the time. Like they'll have, 2 or 3 people out of 10 that are just sitting in the sales team and they're just skating by. And the company's looking at it and going, well, our sales team's producing X, but then we either train those 3 people up or we replace them with 3 producers. And all of a sudden they're like, geez, we have great sales numbers this quarter. What happened? Well, when I talk to the 10 sales team members and even the 3 that are skating, 6 out of the 10 might tell me, yeah, these 3 people are skating by, but no one took action on it until it was revealed. And that is a huge leak in a company, huge leak.
Yeah. You've been involved in some major revenue growth and turnaround situations. What have those experiences taught you about the hidden profit that many founder-led companies already have inside the business?
Wow, it's a great question. So I'll tell you what I've really learned, which probably is more helpful to a listener at this point. No matter what company you have or what size company you have, what I've learned is there's bleed going on in the company. And it's kind of like people will say this, it's like pouring water into a bucket that has holes in it. If you continue to pour more water at a higher velocity or higher volume, it's just going to push out the holes. And then because the integrity of the bucket is not so strong, it's going to break a seam somewhere. But if we went through and patched a bunch of those holes and you only had 1 or 2 leaky holes in there, and then you put more water through there, right, it won't push out through those holes as fast, because now if we repair all of them, it's going to be time to get another bucket and another bucket and another bucket,
You're
or a
going to
bigger
need a
bucket.
bigger
Right?
bucket. Yeah.
Exactly, right? And so, I have learned no matter what. I mean, I've worked at, on super high end accounts that are, Procter and Gamble and Enterprise Rent a Car and Intuit and things like that. They have leaks. And those are big leaks, number wise, because they're big companies. But I've also worked with companies that are doing, $1 million and or even smaller. And they have leaks too. Proportionally, sometimes those leaks, like that $221,000 leak compared to the 772, that's a pretty big leak going on in the company. But there was
Yeah.
a lot of tiny little leaks that added up to that. So, if you can fix the leaks, then you can grow and scale the business. But if you don't fix the leaks, it's like an airplane has three components to it. It's thrust to get it off
Thrust,
the ground. So
lift.
they push down the pedal, if you will, but in this case, the handle. And so the airplane starts going. Then there's lift. That's what pushes the pressure up off the ground, if you will, or how an airplane works, and lets the airplane go up in the air. But then there's drag,
Yep.
and drag keeps us from floating off into space, so to speak. However, when there's too much drag, you will burn a ton of fuel trying to get from coast to coast.
Yeah.
Way more fuel than you want to burn. In fact, many times you might even run out of fuel and end up in the middle of the United States versus the end of your journey. So part of it is cutting the drag and then building in the lift. The big challenge I see, Mike, is most founders are trying to just focus on the thrust. And that's why they're focusing on the revenue growth in the business without addressing the other two.
Yeah. You talk about, your bucket analogy, which is a great visual. The author, Jim Collins, in his book,
Yes.
Good to Great, was, pretty famous now by coining the phrase, good is the enemy of great. And I would imagine
Right.
good, for many companies, is a company with a bucket with some holes in it, but enough flow of water so that the bucket stays relatively full.
Yeah,
So, and I think sometimes those little holes in the bucket is what could separate good from great. And
without question.
and a lot of companies are very close to great, but I remember in building my company, which I started 34 years ago. At first, we didn't even do good, right? We were just hoping to not suck too badly, right? And
Yep.
and then once we got to break even, I'm like, okay, we're not doing bad, at least from my relative perspective. And then we started doing good. And I just wanted to stop getting better because I didn't want to risk good for the possibility of trying to be great. I was
Yeah.
just so hell bent on making sure I did not do bad anymore that
Yep.
I was very content. There's a seduction of being good enough, right? And it takes a special leader, a visionary of sorts, to be able to not be satisfied with good. It's just like the line in the movie, son, good isn't good enough. You got to do great. And I think by patching the leaks, many early when we wanted to start being greater than good, one of the things I did is I went through my chart of accounts. We're a small business, so the founder has access to that. I went through the chart of accounts, section by section by section, advertising, travel, entertainment, subscriptions, and I'm just like, I was amazed at what I found. If I just looked at the total advertising, total subscriptions, total whatever, didn't tell me anything. When I looked at each line item, I just
Yep.
went through with a black Sharpie and said, okay, this is gone, this is gone, this is gone, this is gone. No one even noticed. There was no
Yep.
slowdown. And I cut maybe about 10% off of our annual expenses in stuff that we didn't even know we had. It was death by 1,000 leaks, right? And
Yep.
and then a few months later, I'm like, that was fun. I'm going to do that again. And I found another 2 or 3%. And then
Yep.
several months later, I went through it again and I found 1 or 2%. And it's amazing what you see when you look. And I think many founders are so busy, rightly so, building their business, working in their business as opposed to on, that we think, well, that's a small number. I've got bigger problems. They don't realize it's the totality of all those small numbers that create the bigger problem.
Yeah.
That resonate with you?
Yeah, I see it every day of my life.
Yeah.
And so exactly what you just said. And, and there's pure like cost reduction, like you were looking at a lot of the line items. There's also doing that for the sake of this just isn't working. It's not optimally, right? So for example, a lot of times and I'm not picking on marketers, a lot of times I'll look at marketing in general and I'll be like, why are we spending this amount on marketing? And they'll say, well, because we need to do this. And that's like, okay, so let's segment what marketing is actually doing, or, these reach out type of activities are actually doing. And then once we segment them out, like you did on the line items, then we can say, wow, you know what? We're paying $800 for every pay-per-click ad that's coming through, and we're closing 1 in 10 of those. I'm just making the numbers up.
Yeah, sure.
Right. So we're spending $8,000 to acquire this client, and we're only getting $10,000 out of this.
Yeah.
So now when you add in cost of delivery and all the other things, it's like you're probably losing money on that client.
Yeah.
But since it's blended in with the other 11 things that are going on, and we're only looking at the number in total, then what will happen is that bleed will continue. And so we have to find a way to either lower that cost or find a different way to get that client, or possibly even eliminate that completely from the mix, depending on what the goal is of the company.
Yeah.
And but without visibility, and that's the challenge. Most founders and people who own companies, looking at the numbers, they don't have visibility. They have numbers, but they don't have visibility into what the numbers are actually telling them.
Yeah.
And that's where we lift the curtain and we pull back everything and we go, okay, here's the menu of things that are going on within the company. And now you as the founder can make a decision. What do you want to do about this? And that can be from every single department across, before it touches the client to all the way to the end. There are so many companies out there, Mike, that are just leaving like money on the table because their customer service department, for example, is not set up to actually sell something.
Yeah.
And they won't incent their customer service department to sell something. And if anybody wants a great experience at what I'm talking about, just call into GoDaddy, go buy a domain, call into GoDaddy, and GoDaddy does an amazing job on their customer support side. You will not walk off that call, get off that call without buying something else or many other things. But, that's a profit center now, I suspect, for GoDaddy. I haven't looked at their numbers because they're so good at it. And otherwise, all that money is just bleeding out of the company. And guess what? It's going to the competitor.
Yeah. In the few minutes we have left, I want to end with this question, which I ask all my guests. Earlier in your career, how did you define success, and how do you define it now?
Early in my career, on the business side or on life side?
Either.
Early in my career, I think we all go through different life cycles and life things, right? So early in my career, I was solo, didn't have kids, wife, homes, all that stuff, and I was bound to be a professional musician. That was my goal, right? And so I would have defined success back then, not by my business goals, but whether or not I was able to get on stage and, how many people in front of me could I see up on that stage, right, out in the audience. Now, I'm 64 years old now, so I determine success a little differently. I determine success by the quality of my day, the quality of my week, the quality of my relationships. the ability to do the things that I set out to. I'm far more risk taker now when I'm now at 64 than I was when I was 20. And the reason behind that is, I would say, it's wisdom, not to be arrogant or braggadocious about it, but when you get to a certain point, like Henry Ford said, and you lose it all and you can gain it back in a year or two, you don't live in fear like you did when you were in your younger years, thinking, oh my gosh, if I lose this job or I
Life
lose
is over.
that.
Yeah.
If I lost this girlfriend, I will never have another one like her, right? And that might be true, but you generally will get another one. And sometimes it is much better than what you even had thought about. So I've learned now that success to me is taking, I would say, the quality of my day and also living into and taking the risks on myself of who I know I am today, which I didn't do as much when I was younger. Probably one of the reasons I wasn't one of the artists that we listen to on the radio today.
Right. Well, that's a great answer. To my audience who would like to get more information on Doug's company, CEO Sales Strategies, if you're watching this on YouTube, look right down here. It's right below me. It says See More, and click that, and the URL for his company will be there. If you're listening to this on your favorite podcast app, of course, just go to the podcast app's show notes section, and that information will be there as well. Doug C. Brown, thanks for being my guest today. This was a great conversation. I really appreciate the generosity of your time and the sage advice and sharing your journey with me and my audience.
Well, thank you, Mike. I'm so grateful to be here, and I hope that our time has inspired somebody to take a different pathway if they're in that place where they should, and they're like, oh, okay, now I get it. I'm going to do this.
Well, I can guarantee
that would have made it.
80% of my audience was probably going, that's us. He's talking about us. That's exactly us. So I'm sure that we've inspired them. You've inspired them to dig deeper in their numbers and kind of, turn over the stones and go through the chart of accounts, whatever applies in their world, and find hidden profit, which that is your talent. Thanks again, Doug. I really appreciate you being on the show.
You're welcome, Mike. Thank you.
All right, here's some final thoughts. One of the biggest traps in entrepreneurship is believing that growth will automatically solve everything. But revenue is not the same as profit. Profit is not the same as cash flow. And activity is not the same as enterprise value. Doug reminds us that before we chase more leads, hire more people, or spend more money, we should first ask a simpler question. Where's the money already hiding inside the business? For founders, that question can be uncomfortable because it forces us to look at the places we may have ignored: pricing, follow-up, customer retention, margin discipline, sales process, and the assumptions we've been carrying for years. But that is also where the opportunity lives. Sometimes the next level of growth is not about adding more. Sometimes it's about finally capturing what the business has already earned. Now, that is a wrap. Thanks for being part of our Reluctant Entrepreneur family. We've been very busy recording future episodes with fascinating guests, so be sure to subscribe to get notified when new episodes drop. If you're an entrepreneur or know someone who would make a great guest, of course, we'd love to hear from you. Visit reluctantentrepreneur.podcast.com, where you can apply or recommend a guest or just learn more about the show. And a couple of shameless plugs. I've started a new series under the Reluctant Entrepreneur brand. The new series is called Reluctant Lessons, Where Businesses Go Wrong. On this series, we dig into high-profile business failures and the story behind it all. So far, we've profiled numerous companies, including Rubbermaid, Kodak, Blockbuster, BlackBerry, Toys R Us, DeLorean Motor Company, and our newest release, Borders. And there's many more to come. Turns out there's really no shortage. Check them out on this channel. And if you're interested in my book, The Reluctant Entrepreneur, Anatomy of a Business Startup from Uncertainty to Unstoppable, it's available in paperback and Kindle on Amazon, and as an audiobook on both Audible and Amazon. And finally, to everyone listening or watching, if you find yourself stepping into entrepreneurship, whether by choice or by circumstance, remember this: sometimes the path we never planned becomes the journey we were meant to take. Thank you all so much for being here. I truly appreciate all of you. I'm out of time. I gotta go. I'll see you again soon.